Welcome back. Now in this topic, we are going to be discussing more about what is a belated return, what is a loss return, what is a revised return, when can I revise the return, and some questions which you will need to understand to be able to answer the question papers. Now we've already talked about two types of returns. We said one is an original return, the other is a belated return. The original return we've talked about in detail needs to be filed before the due date, which is either 31st July, 30th September or 30th November. We've talked about returns to be filed electronically. We've talked about returns with digital signature or without. Hopefully you've read the notes in detail and have those provisions inside your head. Now comes the question, can I file a return after the due date? Well, the answer is yes, but as per section 139(4). So now, let's say this is the due date. This is the previous year. Now, beta, the law for 13-14, 14-15, 15-16, the basic provisions remain exactly the same, apart from few amendments. Now, for assessment procedures, even in the paper, the questions may relate to not just 14-15, but the question may be of 12-13, the question may be of 13-14, because the due dates for these years may fall in the current year. Now, my experience tells me that the year that is going on, abhi khatam nahi hua hai, 14-15 is yet to complete. So what happens is, if I take examples of 14-15, they will go to 15-16, 17-18, 18-19, too far away in time. So it's easier for you to comprehend years and dates which you are already aware of. So I might take some examples of 13-14 or 12-13 as well. So this example, to make you understand the entire story, is going to be for 13-14. Therefore, we have April, May, June and July. I'm assuming the due date to be 31st of July. Any return filed over here is a return under 139(1). The belated return can be filed within 1 year from the end of the relevant assessment year. So we have assessment year 2014-15 ending on 31st March 15. One more year, 31st March 16. We also learned that the assessing officer has the power to ask you to file a return. The power is under section 142(1)(1). The details of this section we will do when we go to the powers of the AO or the functions of the AO. Remember, at the moment I told you we are talking about what the assessee can do. So I'm going to give you just in brief what 142(1)(1) says. 142(1)(1) says that by a notice, the AO can ask the assessee to file a return. Now the questions will be, can the AO send a notice during this period, before the due date? Well, of course not. Why not? Because abhi yaar, return ka time is not gone, no? So if there is the return time not gone, I told you this is Lakshman Rekha. So no notice under 142(1)(1) can be sent here. What if the assessee has already filed a return here before the due date? Can the AO now send a notice seeking another return under 142(1)(1)? Well, the wordings of 142(1)(1) start that where an assessee has not furnished a return. Therefore, it is very apparent that if you furnish a return before the due date, then a notice under 142.1.1 cannot be sent. That means if a return under 139.1 has been furnished, then no notice under 142.1.1. Then comes the question that since I have a time period to file a return under 139.4, does that mean that the notice can only be sent after 31st March 16? Because the section says where a return has not been filed. So the assessee is likely to raise a point that if the time period to file a return still exists, the belated return, then the notice can only be issued to me once that time period ends. That is the wrong thinking. Because as per law, the moment this date is crossed, now your safety factor goes. Belated return is not your right, it's a privilege. And please understand the difference between the words. Belated return, the filing of a return late, is not your right. I call it a privilege. That means you can't demand it. By chance you could not file it before the due date, you had some issues or maybe you forgot, you can file a return late unless you're caught. Because when we read the time period to file a belated return, let's go and do that. Section 139.4 says, if a person has not furnished a return within the time allowed under 139 or within the time allowed in a notice under 142.1, then he may furnish the return of income at any time before the expiry of 1 year from the end of the relevant assessment year or before the completion of assessment, whichever is earlier. Now, to be able to understand this, I'm going to teach you a bit about assessments, a bit about the completion of assessments as well. So we go back. So the time period for a belated return is 1 year from the end of relevant assessment year or completion of assessment. Whichever is earlier. But before we are doing that, we are first understanding, can a notice under 142.1.1 be issued within this period as well? Well, the answer is yes. That means after the due date, there are two types of returns possible. And I want you listening very carefully to this. One is a return in pursuance of a notice under 142.1.1 and the other is a return under 139.4. That means after the due date, there are two things. Either there is no notice issued to you, so you get this time period. If you file a return, it's a valid return, it's a belated return. But if during this period you get a notice under 142.1.1, the notice will specify the time period within which you are required to file a return. So if you file a return within that time period, that's a return under 142.1.1. So we take examples. We say assessee files a return on 1/1/15 under 139.4. Now the forms of returns are exactly the same. That means whether I'm filing an original return or a belated return or for that matter a revised return, well, the form will remain the same. This is ITR 1 form, also referred to as Sahaj. Now, over here, if you notice, if you're filing a return before the due date, you specify that. If you're filing after the due date, you take 139.4. If it's a revised return, you fill this. Or if it's in response to a notice under 142.1, and slowly when we do 147, you will understand that there's a notice under 148. Defective return 139, or a return for block assessment 153A, B or C. So the form of return remains exactly the same. So if you are filing a belated return, you will just tick 139.4 and fill up the form. So we were saying this is a return under 139.4. But what if I now receive a notice on 1/3/15 under 142.11 seeking a return that I am going to be filing. Now this notice is not valid because I have already filed the return on the date I received the notice. Had this notice been received on 1/11/14, obviously by that time I have yet to file a return. 142.11. Now the notice gives me 20 days to file a return. The day of service of notice will be excluded. So the first we will exclude. We have 20 days to file a return. That makes it 21st of November 2014. If the return of income is filed within this time period, let's say 20th, then this is after the due date, but it is a return within the time period mentioned in the notice under 142.11. Therefore, it's a return, we say, under 142.11. Is it a belated return? The answer is no. Now, what is the difference between a return under 142.11 and a return under 139.4? Let's go and check. One, these are after the due date. Both of these are out after the due date. But by the wordings of section 139.4, be rest assured, have a look, read. If a person has not furnished a return within the time allowed under 139.1 or within the time allowed for a notice under 142.1, then the return filed is a belated return. Therefore, by this very definition of the belated return, a return under 142.11 is not a belated return. It is after the due date, yes, but it is not a belated return. Then as per section 80, we have carry forward of losses. Is the restriction of section 80 applicable to both these returns? Which means whether I file a return under 139.4 or I file a return under 142.11, there can be no carry forward of loss. Except when we did set off, we talked about 71B, which is house property loss, 32.2, unabsorbed depreciation, and we need to mention over here 73A, which is specified businesses, covered by 35 AD, if you remember, and you should. We had cross-country natural gas, cold storage, warehousing for agriculture produce, and all those specified businesses where the entire capital asset cost was allowed as a deduction. Now these three are not mentioned under section 80. Therefore, these three losses can be carried forward even if the return is filed late. And when I say late, is after the due date, because section 80 is only concerned with the time period under 139.1. So section 80 says to carry forward all losses, you need to file the return before the due date under 139.1. Thus, the restriction of section 80 is applicable to both the returns. Then we talk about revised return. Now, as per section 139.5, a benefit has been given. This return can be revised, this cannot be revised. Which means if you file a return, and we will do questions in a little while, if you file a return within the time period of the notice, well, at least you've complied with that part. Then we look at penalty under 271F and interest under 234A. Well, it brings us to the question that if I am not compulsorily required to file a return, no compulsion. Let's say my total income or the GTI before deductions is 1,80,000. Now I do not require to file, I'm being an individual, I am not compulsorily required to file a return. But if I do file a belated return, now in this case obviously no penalty is leviable because I am not compulsorily required to file a return. There will be no interest because remember interest is based on tax, and when this is no tax there is no interest. Similarly, there will be no penalty or interest here. But if the question again, sorry, would be here, can I get a notice under 142.11 even if I am not compulsorily required to file a return? Yes. Now if the AO feels that he wants to check your income and he wants to see your return, well, he can send you a notice. Even if your income as per your calculation is less than the minimum exemption slab and you are not compulsorily required as per 139.1 to file a return, once you get a notice. Now to file a return under 142.11 will be compulsory. Now under 142.11 and 139.4, if it was compulsory, say the assessee had a tax which was coming to 4 lakhs. Now he should have filed a return under 139.1. If he files a belated return, will be leviable. Of course, after the end of the relevant assessment year, interest under 234A will be levied. Similarly, it will be levied here. Even if you file the return within the time period mentioned under 142.11. Only then am I talking about the return under 142.11 within time of notice. Now what happens if you default? In complying with terms of notice? That means over here you got a notice, you needed to file a return within 20 days but you did not. But you did file it, let's say by 22nd of November 14. That means you filed a return but after the due date or after the date mentioned in the notice. Is that a valid return? Well, it's not a return under 142.11, that's for sure. But since it is within the time period, in the notice under 139.4, within the time period of section 139.4, it is within 1 year from the end of the relevant assessment year. Assessment has yet to be completed. Well, it is a valid return. But this time it's a return under 139.4. So we say default in complying with the terms of notice, that means return is filed after time period. Then it can be a return under 139.4 if within time mentioned there. Well, I'm going a little slow and I want you to understand these provisions because only then will you be able to answer the questions we're going to raise in the next few minutes. In addition to that, there is a penalty prescribed, rupees 10,000. Now this penalty is for default of 142.11. This will be in addition to penalty and interest which is for default of 139.1. If you did not file a return, you got a notice but you did not file a return at all, you did not reply to the notice. That means now what you've done is you got a notice under 142.11, no reply, no return has been filed. Well, now we know there is a penalty of 271(1)(c), which is 10,000. And in addition to this, now this default is covered by 144, which means now the AO may proceed with best judgment assessment. So there are a lot of consequences if you do not comply with these. And you need to memorize these. When I do 142.11, we will probably go through them again. Let's go through these charts again. So a return after the due date is either a return under 142.11 or a return under 139.4. Can I get a notice under 142.11 before the due date? No. Can I get a notice under 142.11 after the due date? Yes. Can the assessee say I still have time period to file a belated return? No, because filing a belated return is your right. No. It's a privilege. It's not a right. What if I do file a return within the time period mentioned in the notice? Well, it's a return filed late, but it is within the time period of the notice. It can be revised. But if you were compulsorily required to file a return under 139.1, you will be levied interest and penalty. Losses cannot be carried forward because Section 80 gives no special privilege to such a return. It only says the return should be before the due date under 139.1. However, we know now house property loss, unabsorbed depreciation, and specified business loss can be carried forward because these are not restricted by Section 80. One of the reasons is this section was added after Section 80 was, and so was this. Then, if there is a default under 142.11, there is a penalty of 10,000 rupees. And if you do file a return after this notice, it may still be a valid return, this time under 139.4, but then penalty can be levied. A notice under 142.11 can be sent even if you were not compulsorily required to file a return under 139.1, and the default of 142.11 may even lead to the best judgment assessment. Now, having understood 142.11, let's go and look at the time period of 139.4. It says before the expiry of 1 year from the end of the relevant assessment year or before the completion of assessment. Now, section 144 and 143.3 are the two assessment sections we talked about. Scrutiny, I said, is dependent upon return of income, because the notice for scrutiny is mandatorily needed to be served under 143.2, which is 6 months from the end of the year in which the return was filed. Now, if I have not filed a return, there is no scrutiny notice that can come. Therefore, when we talk about the time period for filing a belated return beta, and it says 1 year from the end of the assessment year, we understand before completion of assessment, that assessment cannot be scrutiny. So 139.4 cannot definitely be referring to scrutiny assessment. Then we are looking at best judgment. Now, I told you best judgment assessment has 4 defaults. You've not filed your return. You got a notice for scrutiny, for tax audit, or 142.1. One of the defaults is you've not filed a return under 139. And when we do talk about 144, we will learn that 144 says you did not file a return up till the date of show cause notice. So there is a show cause notice that needs to be issued under 144, giving an opportunity of the assessee to be heard and say as to why he committed the default. Because remember, BJA involves a lot of guesswork. So the AO can actually take a calculated guess at your income without actual facts, without looking at your books of accounts, without taking into consideration the returns you filed. So that power must be judiciously used. So before he actually sits in his office and makes an assessment of your income, he must give you an opportunity to be heard, and that is by issuing a show cause notice. The question is, can he over here, if I have not filed a return up till the due date, say on 1st of October 14, send a show cause notice saying that, look, I did not get your return, I'm taking your case in BJA. Well, the answer is yes, because up till this date, you had not filed a return, and I repeat for the last time, 139.4 is not your right, it's just a privilege. Now, there is a difference between starting an assessment and completion of assessment. There is a judgment, a landmark judgment in CIT versus Purushottam Das, T. Patel. Now this judgment gave us when is assessment supposed to be complete. Now let's go through the procedure. The assessing officer in this particular case that we have is sitting in his office. Maybe he has this assessee in mind. He is waiting for the return. He does not get it by 31st of July. Now you might say that he must ask for a return. He must send a notice under 142.11. Well, that is not a compulsion. The wordings of 142.11 say AO may send a notice under 142.11. It's not a compulsion. He may immediately send you a show cause notice. So we said there are 4 defaults here. For BJA, there are 4 defaults. One is non-filing of return, no response to scrutiny notice, no response to notice under 142.11, and no response to tax audit notice. It is a default enough. You not filing a return. He will not need to send you a notice. We will do 144 in detail. So this notice is valid. Now you may go back to the AO and explain to him, look, there was reasonable cause. I was prevented. I was out of the country. There was a death in the family or any other case. If you do convince him, then he may drop the proceedings. That means after the show cause notice, he will cancel it. But when he sent you the notice bidder, he will have opened a file. In your name, obviously, or in the name of your assessee, why your name? He would have said over there, he would have noted that on this particular date, the notice was sent. And if the assessee comes, well, he will note down what day the assessee came, what was stated by the assessee, and if he is convinced, he will note down that he is dropping the proceedings, signature of the assessee will be taken, and that's it. Now what can the assessee do? The assessee will obviously now file a return. Because he is convinced the AO that there was reasonable cause. So of course the AO is now going to wait for the return. Now this return he files is a return under 139.4. Because it is within 1 year and it is not after completion of assessment. There is no assessment made. Now after AO receives this return, he may want to check it in detail. Now he can issue a scrutiny notice and take it up for scrutiny. But BJ has stopped. Okay, now let's take another case. The assessee got a notice for BJA. The file is open. There is no response. Now the AO will collect information. He will use powers given to him under section 133, I told you. Send a notice to your bank. Collect information from people connected with you, and based on his understanding, he will then pass an assessment order. But he must give a reason for whatever he is adding, whatever he is. So, for example, he gets information that the assessee bought a BMW during the year. His bank statements are showing a positive balance. So all of this data, he will make a little bit of guesswork, but he will have to write down the reasons as to why he is adding whatever he is. And then he will make an assessment. So he will now make an order. Under section 144, which is calculation of total income. He must sign the order. There is a sheet of paper that will be treated as the assessment order, written on top, assessment order, and put it in the file. Then there is something called notice of demand. Under section 156. Now after having calculated total income, the AO will quantify tax and raise a demand. That means a separate notice under section 156 will be prepared specifying the amount of tax that is to be demanded from the assessor. Now obviously you can't just make the notice and keep it in your file. You must send it to the assessor. So the day the notice of demand is prepared, it will be signed on that day. We said date of preparation. Then on that day or the next day, it will be sent to the dispatch department. A day the notice is issued, and then on a day it will be served. When I say served, it will reach the assessee. Now if all these dates are different, the date of making the order, the date the notice of demand we say is prepared, the date it is issued, and the date it is served. Out of these, as per judgment in CIT versus Purushottam Das T. Patel, we learnt that this is the date of completion of assessment. So the date the notice of demand is prepared is the date the assessment is said to be complete. After that, the notice will be issued and served. Now this is going to be very important when we go and look at the validity of the assessment, because remember, as per section 153 I told you, the assessment must be complete within 2 years from the end of the relevant assessment year. So we are looking at previous year 2013-14. The notice of demand is prepared on 31st March 17. It's issued on 1st April 17 and served on 3rd April 17. Is this order valid? Because the assessment must be complete, section 153. The assessment must be complete within 2 years from the end of the relevant assessment year, which is 2014-15, 31st March 17. Since notice of demand is prepared before that date, even if it is issued and served after that date, this assessment is valid. Now let's go back to our example and let's check again. Now the BJA continues. The assessee files a return on 1/1/15. He gets to know through some sources that his BJA is open. Now he files a return. The order for BJA, the notice of demand is prepared on 1/3/15. All we are now discussing is this return a valid return? Now as per section 139(4), a return filed within 1 year from the end of the relevant assessment year or before the completion of assessment is a valid return. So the assessment is completed here when the notice of demand is prepared, signed. This is a valid return. Will the AO take this return into calculation of his total income while doing BJA? Well, that we will discuss when we do best judgment assessment. So what we've done here is what is a belated return. Let's do a few points here. Interest, we know under 234A will be levied penalty where it is compulsorily required to file a return and filed it after the end of the relevant assessment year, then a penalty of 5,000 in addition to interest, but it may be noted that penalty leviable may not be levied if the assessee proves that there was reasonable cause for delay. And we've just talked about Purushottam Das T. Patel. The assessee files a return for the previous year 10-11 on 1/10/11. The assessment order is prepared on 25th December. Notice of demand is issued and is served on the assessee. Is the assessment order valid? We said previous year 2010-11. Now, assuming the time period of 2 years as it currently stands, assessment year 2011-12 and 2 more years, 31st March 14. The notice of demand is issued on 1st January. It is served on 3rd January. The assessment order is prepared on 25th of December. We've not been given the date of preparation of notice of demand. We can only assume it is obviously before the date it is issued. So we can assume it to be 31st of December or 1st of January. In both cases, it is before 31st of March, therefore it is valid. However, having said that, without wanting to confuse you beta, section 153 now says 2 years, but for that year, it used the word 21 months. From the end of the relevant assessment year. Now, if we take 21 months, then the time period for completion will be 31st December 13. 21 months from the end of the relevant assessment year. 12 months gets you 31st March 13, 9 more months. Now, in that case, this date would have been very important. If it would have been 31st December, then it would have been valid. If it was prepared on 1st January, then the order is invalid. And how do we check this? By looking at the file that is there lying with the department. Can a return be filed after the order of BJA is passed? The answer is no, because section 139(4) says cannot be done after the completion of assessment. Now, loss return and revised return. Like in the last topic, we discussed that a return will either be before the due date or after it. And after the due date, it will either be under 139(4) or 142(11). What happens to a return under 139(3)? Is an individual compulsorily required to file a loss return? Is a HUF? In fact, is any person other than a company or a firm compulsorily required to file a loss return? So if there is loss, it's only a company or a firm who are compulsorily required to file a return. The others will file a return if they want to carry forward the loss. Which means a loss return filed late by an individual, no penalty under 271F can be levied because the individual was not compulsorily required. But a loss return filed late by a company or a firm, and when I say late means after the end of the assessment year, then there is penalty under 271F that may be levied. But please remember, penalty you will only levy when a notice comes to you. You will not add it to your tax or add it to your return. So a loss return may either be an original return or a belated return. If filed before the due date, it's an original return. And when filed before the due date, provisions of section 80 are fulfilled and the loss can be carried forward. When filed after the due date, it's a belated return. If there is a notice under 142(11) and you file a loss return within the time period mentioned in that notice, then it's a return under 142(11) and all the provisions will be as applicable. Now, two things. Section 80 restricts carry forward and set off. We've discussed this when we've done set off rules, but I'm just going to take you through this in just a minute. which means if for 11-12 there is a loss and the return of that year was under section 139(1), this loss is required to be set off in previous year 13-14, and the return for previous year 13-14 is under 139(4). It's a belated return. Can this loss be set off is the question. Well, because the year in which the loss was incurred, the return was under 139(1), section 80 is happy. The loss can be carried forward and set off even if in the year in which it is being set off, the return is filed late. Because I repeat again, section 80 does not restrict set off of loss. It restricts carry forward and set off. We know it does not apply to house property or specified business, and it also does not apply to unabsorbed depreciation. There is a latest judgment on the point. We might as well keep this point in mind. Can unabsorbed depreciation be allowed to be carried forward in case the return of income is not filed within the due date? On this issue, the Delhi High Court observed that the provisions of section 80 and section 139(3) requiring the return of income claiming loss to be filed within the due date applies to carry forward of business loss and not for carrying forward of unabsorbed depreciation. As per section 32(2), the unabsorbed depreciation becomes part of the next year's depreciation. So 32(2) says any depreciation from last year will become a part of the current year's depreciation and is allowed to be set off as per provisions of the Income Tax Act, irrespective of whether the return of earlier years was filed within the due date or not. Therefore, in the present case, High Court held that unabsorbed depreciation will be allowed to be carried forward even though the return of income of the current year was not filed within the due date. Now let's look at 139(5) revised return. We've talked a bit about it. Now's the time to do it in detail. If a person having furnished a return under 139(1) or in pursuance of a notice under 142(1) discovers on his own any omission or wrong statement, then he may furnish a revised return at any time before the expiry of 1 year from the end of the relevant assessment year or before the completion of assessment again. Well, one thing is very clear. Once the assessment is complete, you can't have assessee filing a return. What will be the purpose of that return? So no return can be filed after the completion. And the word completion, again, we know is the date on which the notice of demand is prepared. Now this omission means something that you missed. Wrong statement is something that is mentioned wrongly in the return. But the words used are bona fide. Bona fide omission or bona fide wrong statement. That means technically, you must only revise a return if you discover a mistake which is a mistake, not an intentional mistake, or a mistake which is unintentional, bona fide, in good faith, of having missed out something, omission, or having mentioned something wrongly, not with a bad intention, but it was just a mistake. The problem is who's going to prove whether it was an intentional mistake or it was an unintentional mistake. That we'll discuss later. We'll do the case study on that. Let's first go through the simple basics. Now, because a revised return is a separate form. Now understand, you've already filed a return earlier. I showed you the forms. You would have either mentioned 139(1) or 142(1). Remember, no other return will be revised. A belated return under 139(4) cannot be revised. A return under 148 or 153A also cannot be revised, because the concept of revised return is only given under 139.5, which means if there is a mistake in these returns, well, so be it. That mistake is a mistake. It cannot be automatically on your own rectified by filing a new return. So once you filed a return earlier, you've discovered a mistake. You want to revise it. What will you do? You'll pick up this form again. You will recalculate or show the entire return again, but only this time you will take 139.5. Now, in the departmental records, there are 2 of your returns that have gone. What happens to the first return now? Well, the revised return overrides the earlier return. That means once you have revised a return, the earlier return is deemed not to have been filed. So we say the revised return substitutes the original return from the date the original return was filed. So we have a judgment in CIT versus Dhampur Sugar Mills. Why is this judgment important? Now what we're going to start doing is a few of the questions I'm going to do with you. Okay, we say there is an individual, and for the assessment year 13-14, he files a return on 1/7/14. Now this is your client. These are the facts of the case. We have to give our analysis of the situation based on the knowledge we've gathered. He is doing business. It's a proprietary concern. His turnover is less than or equal to 100 lakhs. In the return, he furnishes a loss. House property 1 lakh and business 3 lakhs. He then discovers that there is a mistake. He revises the return on 1/3/15 by disclosing the losses as 3 lakhs and 6 lakhs. The question now would be a few questions to be asked. Is your client compulsorily covered by 44AB? Well, since the turnover is less than 100 lakhs, no. Is this return that he has filed here valid? Well, it is assessment year 13-14, which means by 31st March 15, the return could have been filed. It is within 1 year, no notice has been received, nothing, so the return is valid, but it is a return under 139(4). Was he compulsorily required to file a return? Well, him being an individual, a loss return is not a compulsion. That means penalty of 271F cannot be levied. This is after the end of the relevant assessment year. Therefore, we say no penalty. Why? No compulsion. Under section 139(1). Had this been a firm, well, a penalty of 5,000 could have been levied now, because it is after the end of the relevant assessment year. There obviously cannot be interest beta, because interest is on tax and this is a loss, so there is no tax. There cannot be an interest. The point is this return filed on 1/3/15 valid? No. And why is it not valid? Because a belated return cannot be revised. So the revised return is invalid, deemed never to have been filed. What is the loss in the current year now? Well, there is a 1 lakh loss here and 3 lakhs business loss. Can it be carried forward? The house property loss can be. Business loss cannot because of section 80. Then a question is asked, how much house property loss can be carried forward? 1 lakh or 3 lakhs? Now technically he's shown a loss of 1 lakh now. Had he not filed a return, well, next year he could have shown the loss of 3 lakhs. But he's filed a return. Now next year the department will only allow 1 lakh to be set off. In case he wants to claim 3 lakhs, he'll have to go under section 154 to get this rectified. And of course we shall discuss that later. But at the moment, without that, he can only carry forward 1 lakh. Let's take another one. There is an individual again, and this time previous year 13-14, turnover being less than 1 crore. The return is not filed before the due date. He receives a notice under 142.11. He receives a notice on 15/12/14 and has to file a return within 20 days. He's filed a return on 31/12/14. It is within 20 days and he's filed a loss. Thereafter, he revises the return. Again, we are asking questions like, is he compulsorily required under 44AB? No. Is this return a valid return? Well, it's a return under 142.11. Will he be levied interest under 234A? No, there is no tax. And him being an individual was not compulsorily required to file a loss return, therefore penalty under 271F will not even be discussed. Is the revised return valid? Well, now we know that as per section 139(5), a return under 142.11 can be revised. Therefore, this return is now valid. Which means in the current year, there is a house property loss of 3 lakhs and business loss of 6 lakhs. But what use is it till the time I can't get a carry forward? So the question that is more important is, can this loss be carried forward? Now the loss carry forward is only covered by section 80 or restricted, by section 80. And section 80 does not give any special benefits to the return under 142.11. So what do? The answer remains the same. The house property loss can be carried forward, but the business loss cannot be carried forward. Why? Because remember, the loss return is after the due date. Therefore, the carry forward will only be house property loss, this time 3 lakhs. Well, let's take one more. For previous year 12-13, the return is filed on 1/7/13. Not covered by 44AB. Therefore, the due date obviously is 31st of July. This return is a return under 139(1). Finally, we have a client who's filed a return before the due date. He has filed loss. Was he compulsorily required to file a return? No. There is no question of interest because there is loss. There is no question of 271F for 2 reasons. One, he's filed a return before the due date. Second, he was not compulsorily required to file a return. Then he revises the return. Now the revised return is valid because a return under 139(1) can be revised under 139(5). So it's a valid return. Then comes the question of carry forward of loss. Now when we look at carry forward, you tell me, is the revised return a separate return? I just explained to you, a separate form would have been filed. Of course it's a separate return. Now what happened in CIT versus Dhampur Sugar Mills? Now the assessing officer said that fine, this return is valid. You're right. Because as per section 139(5), an original return can be revised. Fine, agreed. So in the current year, you have loss of 3 and 6. But he says, I will not allow carry forward. And why is he not allowing carry forward? He says, because as per section 80, nowhere has it been written that the revised return will be deemed to be filed on the day the earlier return was filed. Section 80 simply says the return must be filed before the due date. And he says the loss in this return is not before the due date. Well, the assessee says, let me carry forward this loss. He says, no, that's an invalid return now. It's been overwritten by the revised return. Therefore, I cannot allow you to carry forward the loss. Now that leads to a very big problem here. What if the losses were 80 crores? Assessee has made no fault. He filed the earlier return before the due date. He's filed the revised return within time. Yet, because of a technical difficulty in the interpretation of the statute, literally, the AO might be right. By literally saying that section 80 will only carry forward the loss if the return is filed before 31st July, which might not be feasible for a revised return, which then defeats the purpose of allowing revision. If I can't revise the return to carry forward my loss, then what is the purpose? So here is where the judgment in CIT versus Dhampur Sugar Mills tells us that the revised return substitutes the original return from the date the original return was filed. But this is only for carry forward of losses. Once the revised return is filed, the original return is deemed to have been withdrawn and the revised return is deemed to have been filed on the date the original return was filed. The revised return steps into the shoes of the original return. So now this return is deemed to be filed on this date, and because this date is before the due date, therefore section 80 will now allow the carry forward of loss. So 3 lakhs of house property loss and 6 lakhs of business loss can be carried forward. Now if I take the same case in the earlier example we did, even if I apply the concept given in CIT versus Dhampur Sugar Mills, this revised return will be deemed to be filed on this date, which is after the due date. Therefore, even if a return under 142(11) can be revised, losses cannot be carried forward unless, of course, it's house property loss, unabsorbed depreciation, or 35 AD loss. When I say only for carry forward of loss, when we do 143(3) and 2, I will discuss this in detail. Let's just keep going now. Section 139(5) provides that only a return filed under 139(1) can be revised. Therefore, a return under 139(4) cannot be revised. CIT versus Kumar Jagdish Chandra Sinha, 1996 Supreme Court. A return filed within the time period extended under 119. That means if the due date has been extended, we've done that CBDT can extend the due date. If I file the return after 31st of July, but within the new due date, can that return be revised? Well, of course, because the new due date is also now the due date. So, is a return and it can therefore be revised. Well, the method of revising a return, how do we do it? Like we just saw, you pick up the form and you take 139(5). Now let's take a case and let's see how and what points have been raised here. Now for the year 12-13, suppose the return is filed on 1/7/13, which is original return. Now scrutiny notice was received on 1/6/14. We know 31st March 14 is the year of return and 6 months is 30th September 14. The notice must come before that date. It's a valid notice. The assessment we know as per section 153 must be completed within 2 years from the end of the relevant assessment year, that is 31st March 16. Now while going through the assessment proceedings, remember the revised return can be filed before completion of assessment. Within 1 year from the end of the relevant assessment year. So assessment year 13-14, 1 more year, 31st March 15. Now what the assessee did was, he realized during this discussion with the AO that he had claimed an expenditure for 1 lakh, whereas the expenditure actually was 10 lakhs. It was a mistake. What he does is he writes an application to the AO saying, look, my dear friend, by mistake, I have claimed expenditure of 1 lakh, whereas the expenditure was 10 lakhs. This he did on 31st March 15. According to him, he is in time. What the AO did was, he passed an order on 1/7/15, but he ignored the claim of the assessee. Now, after this case will go into appeal. It's a technical problem pointing out, is this valid? Is this claim valid? Can I revise a return by simply writing a letter to the AO? I have not gone to explain it to him. I have not filed a valid revised return. Is he duty bound to admit this claim? There could be another case here. The case could be that I had not claimed expenditure at all. No expenditure was claimed. Now I have written a letter saying that, look, this is an expenditure I missed out on. It's an omission. It's a bona fide omission. I have written an application saying, please admit that. So I am taking two examples. One, a claim that had already been made, but it was incorrect. Another is that no claim had been made. Now on this point, there is a judgment of the Supreme Court in CIT versus Goetz, India Limited. Now this is an important judgment. You will all remember the names. An assessee cannot make a claim for deduction not claimed in the original return by filing an application. Such claim can only be made by filing a revised return. Thus, a correction in the original return cannot be made by making an application. The assessee needs to file a revised return to make the correction. So, CIT versus Goetz, India, the judge says to make a fresh claim, you need to file the revised return. You cannot simply write an application. However, an interesting point came up in Orissa Rural Housing Development Corporation Limited versus ACIT 2012. Can an assessee revise the particulars filed in the original return of income by filing a revised statement of income? On this issue, the Orissa High Court held the assessee can make a fresh claim before the AO or make a change in the original filed return of income only by filing a revised return. There is no provision under the Income Tax Act to enable the assessee to revise his income by filing a revised statement. Now I told you, like the batsman and the umpire, the assessee and the AO can only do what is allowed to be done. And if you've not followed the rules, even if you think you are going to be unjustified or it's unreasonable by not allowing this because it's there, well, so be it. You have to follow the procedures. Therefore, filing of revised statement of income is of no value and will not be considered by the AO for assessment procedures. The High Court, relying on the judgment of the Supreme Court, held that the AO has no power to entertain a fresh claim made by the assessee after filing of original return except by way of filing a revised return. Now remember, why is this so important? A revised return will go through the entire system. It will be on record. A simple letter to the AO may be open to manipulation, so law is not going to allow that. You have a genuine claim, please make it through the genuine route prescribed by law. We don't want you dealing with the AO directly too much, because in such a case, there is a chance of manipulations. The law does not want that, without saying that it actually happens, but it does. However, another interesting case on the same point, rectification of wrongly claimed depreciation. Now, depreciation has a very different angle to it. We know depreciation is mandatorily to be given. It's not optional. In fact, Section 32 says that if the assessee has not claimed depreciation, it must be given to the assessee. Now, in such a case, he says the assessee claimed depreciation on a newly installed windmill on the basis of WDV mentioned at the rate of 15%. Subsequently, when the assessee realized his mistake, he realized that on windmill, the rate of depreciation would be 80%. His profits would go down. He filed a letter before the AO to rectify the claim and to provide depreciation at the rate of 18%. Now, from what we've done, this should not be allowed. The assessing officer rejected the claim now, considering the principle laid down by the Supreme Court in CIT versus Goetz. that a fresh claim cannot be made by the assessee other than by filing a revised return. The tribunal held that the assessee was not making a fresh claim. He was not making a fresh claim. He had already claimed depreciation in the return. He was only rectifying it. In fact, the assessee had made a claim for depreciation, but the rate chosen was not a correct one. Thus, judgment of Supreme Court in Goetz India would not apply to the present case. Further, as per explanation 5, the depreciation would be allowed whether or not the assessee has claimed the depreciation in computing the total income. Therefore, the assessing officer was duty bound to allow depreciation computed at correct rate provided under the Act. This is ITO versus Sri Balaji Sagu and Starch Products 2012. So this point about whether you can write a letter to the AO to revise the return is important. In the final analysis, if it's depreciation, well, we will rely on this judgment. But for any other case, you can only revise the return by filing a revised return, not making an application to the AO. Now just a few more points. Can I revise a return after I have received a notice under 144? Can I revise a return after I have received a scrutiny notice? Well, technically, you can revise a return if there is a bona fide omission. And you can revise a return till the assessment is complete. So even if you've received a show cause notice, you can revise a return. Now, obviously, when you are revising a return, you will claim the intention was bona fide. Earlier, it was a mistake. But it may also be possible that you had, or the assessee had naughtily not disclosed his full income and suddenly he receives a notice. He files a revised return increasing his income. Why does he do that? Well, there is a section 271(1)(c). There is 271(1)(c), penalty for concealment of income. If you've concealed your income, then you are levied a penalty on that concealment. There are different rates of that penalty, but the question is, can that penalty be levied? Now we're going to look at, can I revise a return, and if I do, whatever income I increase in the return, can it be open for penalty? Let's see. A revised return can be filed after a show cause notice under 144 or after a notice under 143(2) has been served. However, in such a case, the amount of income increased over the income shown in the original return may also be subject to penalty for concealment. For example, the AO issues a notice for scrutiny for 12/13 on 1/5/14. Now this is previous year, 12/13. I am assuming the return was filed and this is within time period. The assessee had filed the return, okay, it's given 16 September 13, so this is a valid notice. It is within 6 months, showing income of 1 lakh. The assessee on receipt of the scrutiny notice files a revised return on 15th June 14 disclosing income of 3 lakhs. First, let's check the time periods. He revises on 15th June 14. It is 1 year from the end of the relevant assessment year. Valid return. Assessment has not been complete. You've only gotten a notice. Assessment is yet to be complete. Disclosing income of 3 lakhs now. Well, he's increased the income from 1 to 3. He's obviously paid the tax on 3 lakhs as well. But if tomorrow the AO wants to levy levy penalty on this additional 2 lakhs, can he do so? Now the revised return is valid since it is within the prescribed time. However, the income declared by the assessee voluntarily may further be subject to penalty. But for that, you will have to prove that the mistake made by the assessee was not bona fide. It was malified and that based on the receipt of notice, only then did he revise the return. In such a case, if you can prove it, it's all a matter of proving what the AO proves and what the assessee proves. The penalty may or may not be levied. So what is the law for penalty on income increased in a revised return? We say if income is increased in a revised return furnished after the receipt of notice under 143(2) or 144, but before completion of assessment, the return is valid, but penalty may, I'm not saying shall, may be levied on the additional income declared in the revised return. We have a few judgments on this. Let's look at each one of them. Okay, now the judgments are going to be based on whether penalty can be levied on income increased in the revised return. So we say liability to penalty under section 271(1)(c) and the filing of revised return are mutually exclusive. Bear with me, let's read it together and we will do questions. In case the case falls within the scope of 139(5), there would be no scope for levy of penalty. Why? Because if we fall under 139(5), it has to be bona fide. And if it's bona fide, it can't be concealed. So if the revised return is actually genuinely revised return, well then the penalty for concealment must not be levied. Since as per 139(5), only bona fide omission or wrong statement is a valid reason, then in case income is increased in a revised return, it cannot be concealed. Thus, penalty should not ordinarily be leviable in case on which bona fide revised return is filed. In case, if the case does not fall within the scope of 139(1), that means the belief is not bona fide. The fact that the assessee purported to file a revised return will not absolve him from liability under 271(1)(c). The assessee says, I am disclosing my income. Even if earlier I had wrongly shown it less, I should not be levied penalty because I am disclosing it voluntarily. The judgment says, just because you are showing it voluntarily will not absolve you of the penalty for concealment. He had concealed particulars of income deliberately or deliberately furnished inaccurate particulars. I repeat again, who's going to prove? It's the discussion between the AO, the assessee in front of the judge. However, the blameworthiness attached to the assessee with reference to the original return cannot be avoided by filing a fresh return after concealment is detected by the AO. Tomorrow you say the assessing officer has found out that I have undershown my income by 4 lakhs. I revise my return and say, look, I'm showing it. Just because you've shown it in the revised return does not mean you will not be levied penalty on it. Now let's look at the facts of this case. CIT versus Dr. A. Muhammad Abdul Qadir, 2003 High Court. This will give you an idea of what we are talking about. A revised return does not always spare penalty. Where such a return has been filed after concealment has been brought home. Now the assessee had admitted during the course of assessment, he had admitted that 50 to 70% of his receipts are not recorded. Pakda gaya na? He is now caught. He has admitted. He knows he now has to pay tax, but he is trying to save his penalty. But he claimed that he had admitted the same only during search in a spirit of cooperation in order to avoid penalty and prosecution. So during search, when we do that topic, you will learn that there is a lot of pressure and they record statements, and he had admitted, saying that fine, galti hogi, I've made a mistake, I will pay my tax, just don't levy penalty to me. Can he be spared? The first appellate authority, CIT appeals, deleted the penalty on the ground that the return was voluntarily before proceedings were taken on the returns filed, while the tribunal endorsed the decision on the ground that it was a matter of bargain between the assessee and the department and that penalty is exonerated, is over, on the revised return filed in pursuance of such a bargain. The High Court held that the revised return could not be treated as purely voluntarily since the assessee had admitted concealment during the search. So the CIT appeals and the ITIT have one opinion, the High Court has another. What opinion do we form? Let's keep it simple. If you are filing a revised return and it can be proved that this was revision after the notice was received, penalty may be levied. It has to be proved in the court of law that there was a malified intention. So we say return is filed on 1/7/13 for previous year 12/13, declaring income of 340. So on 1/7/13, he has declared income of 340. Notice is received on 1/4/14. Assessee files a revised return on 15/5/14, declaring income of 5,10,000. The AO passes an assessment order assessing the income at 7 lakhs. Now, this revised return is filed after the notice under 143(2). If it can be proved that this was after detection or after notice and it was not bona fide, then on the difference here of income, penalty will be leviable. How much we will talk about when we do penalties. And of course, on this over here, penalty may be levied if again provisions of 271(1)(c) are fulfilled. If we say return is filed on 1/7/13, declaring income of 340, the assessee files a revised return on 15/5/14, declaring income of 510. There is a notice received on 1/6/14 under 143(2), and the AO assesses income at 7 lakhs. Now you've already revised a return before you received the notice. Very difficult for the AO to prove that it was because of the notice. Therefore, normally penalty will not be levied. But on this, penalty may be levied. Can return for block assessment, and when we do that, you will understand what we are talking about. Let's keep it simple. Only a return under 139(1) or 142(1)(1) can be revised. Any return in pursuance of a notice under 148 reassessment or 153A block assessment, they will ask you for your returns even here. No, they cannot be revised. We know a belated return cannot be revised. How many times can a return be revised? Any number of times as long as it is within the time period given under 139(5). Now, two things we will talk about, and these we will talk about as we move on. But under section 10AA, we just talked about the deduction can be claimed proportionate to the money brought into India within 6 months. So we say assessee is eligible for deduction under 10AA. He is an individual where the turnover is not more than 100 lakhs. That means the due date is 31st of July. The money is brought into India on 30th September 13. So we are looking at previous year 12/13. On 3rd September 13 the money is brought. But he is required to file a return here. The money is brought into India after the due date. What he will do now, he will file a return under 139(1) and then revise it to claim deduction under section 10AA. Because as we discussed, the deduction under 10AA is proportionate to the money brought into India. But you will only know the money brought into India by 30th of September, because that is the time period allowed under 10AA. So in such a cases where the deduction is dependent upon money being brought into India by the end of 6 months, but your due date is before, then you must file a return before the due date and revise it later. When we talk about returns under 139(4)(a), 4(b), 4(c), 4(d), we will learn that if they are filed before the due date, then they are treated as if there is a return under 139(1) and thus they can be revised. We will do that when we reach there.